what is going on, Traders Empire. Hope everyone's well. Hope everyone's blessed. I don't think I'm spotlighted, so I don't know if everybody can see me. But if y'all can hear me, if everybody can see me, can y'all just drop some ones in the chat, just so I know? Because wow, the value that we have going on today, like, oh my God, like I don't even think you guys are ready. Like the last time one of these boot camps was made, like there was so many breakthroughs, like it was nuts. Like it was actually crazy. So a little bit about myself, you know, I've been doing this roughly now for like the better half, just over a year. And honestly, it's been the best thing that I've ever done. Like just being able to fully put myself in the position where I control how much I make, like it's just an unlimited amount of joy. But I don't even want to talk too much because like we need to get right into this. So I need to announce the speaker that is going to be delivering this information. So he goes by the name of Kieran Davis, or the Master of Coin. Now, I don't even know where to begin with this guy because I remember like he helped me out so much, and he's just an incredible guy. He's an absolute incredible trader, you know, someone with a lot of experience, a genuine will to help a lot of other people, right? So I don't want to like talk too much and, you know, share too much of his story because I'm sure he's got too much to say. So I'm just going to pass it right over to you, Kieran, and I'm just going to get ready to lock in and take some notes. Yes, sir.
Sheesh, my guy. Thank you so much for that introduction, my bro. I appreciate you. I appreciate you. I appreciate you. So guys, if everyone can hear me, if everyone can see me, let me get a 111 in the chat. If you guys can hear me, if you guys can see me, I want to make sure everything's working. So we're out here in Bali, Indonesia right now. So if the Wi-Fi is a little bit inconsistent, thank you for understanding. But just so I can really see where everyone's trading ability is, I want you guys to firstly understand that this is going to be an advanced call. I do speak fast, so you're going to have to listen quickly as well. So if you're new to trading, if you're a complete beginner, put a 111 in the chat. If you've been trading for 0 to 3 months, put a 222 in the chat. And if you've been trading anything over 3 months, put a 333 in the chat. Let's really see where everyone's at. Let's see where everyone's at. Let's see where everyone's at. Okay, cool. We've got some advanced traders, got some beginners. Okay, cool. So guys, what I want you guys to understand about this call, and the first thing I want you guys to understand before we even get into the charts of this thing, is the first thing I want you to understand is your psychology. Guys, I want you to write this down. You don't trade the market, you trade your belief system about the market. You see, what a lot of traders do is they come onto the charts, right? You know, and if I share my screen, you know, they come onto the charts, and what they're doing is they're trying to look for buy opportunities, they're trying to look for sell opportunities. What you got to realize is you don't actually trade the market. You're trading your belief system about the market, because how it is you have yourself, right? And again, we're going to get into the advanced, you know, technical analysis. Don't worry, we're going to get into Wykoff, we're going to get into smart money. But if you can't master yourself, if you can't master your psychology, you'll never be able to master the charts. People tell me all the time, Kieran, how do I solve my problems in trading? I'll tell you how you solve your problems in trading. You solve your problems. It's as simple as that. All right. Trading success is not actually found on the chart. It's found what you do off the chart. How you do one thing is how you do everything. So what I want you to realize is you don't actually look at the market. You're looking at your belief system about the market. And when you trade, you're projecting certain feelings and certain emotions onto the market. You will not see the market for as it actually is. You're going to see the market for what you think it is. So what you got to realize before you even trade, you need to be trading from a clear and free state of mind. So before I trade, I like to ask myself a few questions just to make sure my mind is correct. Because again, if our mindset's not correct, then how do we expect to even make money from these markets? And a few questions I like to ask myself before I trade is, firstly, am I in a good headspace, right? Am I in a good headspace? Because if you're not in a good headspace, if you had an argument with your sister, if you had an argument with your dad or whatever it may be, you're going to be projecting those aggressions, projecting those emotions onto the chart. Next one, am I feeling tired? Right? If you haven't got because guys, what you got to understand in trading, there's no boss. You're the boss. So as the boss, you got to just be able to be self-aware and determine if you're in a good state of mind. If you're feeling tired, you're not going to be able to perform efficiently. Next question, am I trading for the sake of trading? Are you trading to literally to prove to other people that you can trade? Are you trading to make money, or are you trading to follow your plan and to follow your rules? If you're not trading and following your rules, you're gambling, and there's no point in you trading, right? The whole purpose of trading, look, a lot of people, traders don't fail because of their lack of winning setups. They fail because of their losing setups. And the reason they take too many losing setups is because they're not following a plan, right? You need to have a predetermined plan of when you're going to get in the market, when you're going to get out of the market, and when you're going to get obviously out of the market if you're wrong or out if you're right. Next question, have you prepared for the trade? A lot of people, they want to jump in the market without preparing. You know, for example, let's say an athlete, right? A boxer, before he has a fight, he's not just going to go into a fight and not warm up. He's going to make sure he's prepared. And guys, please save questions to the end. We'll have a Q&A at the end. But he doesn't just jump into the boxing ring. He prepares, right? Do you know how long Floyd Mayweather trains before he has a fight? He trains for months of hardcore training before he has an actual fight. Because you're a sniper in the market, guys. You're not a machine gunner. And you want to adopt the sniper mentality. You see, a sniper, they go by the creed, one shot, one kill, right? A sniper is going to be chilling for hours and hours and hours and hours just to wait to get that perfect one shot, one kill. They're not going to be going out there with a machine gun and trying to catch everything. They're very patient. They're cool, calm, and collective. And they're making sure that they're getting the high probability opportunities over the things that are just, just subpar setups. And the final question I want you to ask yourself is, am I preserving capital or am I just jumping in the market? Am I preserving capital or am I just jumping in the market? So let's actually get into the smart money side of things. Let's actually get into the chart work and let's actually show you guys a bit more of exactly how these markets actually move. And the first thing I want you guys to understand is every single move is completely intentional. There is no such thing as a random move in the market. You see, it costs over $1 billion, guys, check this out, over $1 billion to move Euro USD by 1 pip. I'm gonna say that again. It costs over $1 billion to move Euro USD by 1 pip. Do you think the market is random? No. Well, look, would you tell me, would you waste a bit? How many pips does Euro USD move every day? Like 150, maybe 200, even more. Again, including all the fluctuations. Do you think they're going to spend billions and billions and trillions on a day-to-day basis just to randomly move the market? No. Yo, every move the market makes intentional. So there's no such thing as manipulation. You just don't understand where true order flow occurs. So what I'm going to teach you today is exactly how to understand true order flow and exactly how the banks move the market. And what I want you to understand is how they move the market is, firstly, they leave footprints on the market. And what we do as traders, guys, as smart money traders, we're not there to predict the market. We're there to react to the market. There's a difference. You see, the market is like a language, right? When you see all these squiggly lines, and I want to actually shout out to my educational platform, IM Academy, because that's where I learn absolutely everything from. So again, everything I learned from there. But what I want you to understand is the market is a language, right? When you see these squiggly lines, when you actually see the chart, it's not random, it's a language. And what it's doing is communicating with you. It's telling you what's going to happen next. The question is, are you listening? Are you listening to the market, or are you trying to tell the market what it's going to do? Before you enter a trade, does it have to react from your POI? Or are you waiting for evidence to tell you that it's going to react from your POI? You see, trading's not about what you do. It's about how you think about what you do. And a lot of people, now, of course, look, there's different levels of learning, right? Of course, you've got to spend time to obviously train your eye to the market and actually overstand how the market actually moves. Because obviously, if you don't have an overstanding of supply and demand, Wykoff, and how the market actually moves, again, you're going to be hitting stop loss left, right, and center. But after you've developed that level of unconscious competence and you actually can understand price action, order flow, you've got to be listening to the market. Again, our biggest problem as traders is we're trying to impose our will on the market. So what I want you to understand is how the market, it moves in terms of supply and demand. What do I mean by supply and demand? Oh shit, we're about to crack 400 participants. Let's go. Keep sharing this out to your groups, family. We're about to go through some mad stuff. So in terms of supply and demand. Now, what do we mean by supply and demand? In simple terms, and again, we're going to go through chart examples. I'm going to go through huge risk to reward trades that will blow your mind, of course, right? It's minor. Happens all the time. But what I want you to understand is the actual thought process behind it. Supply and demand. What do we mean by supply and demand? The only thing that moves the market is supply and demand. Supply is sellers. Supply is where the sellers live. And demand is where the buyers live. Now, how supply and demand is distributed throughout the market or accumulated is, understand this. Sheesh, 400 participants. Let's go. Imagine it's like this. At the top of the market, we have lots of orders. As we go to lower prices, the orders become a lot thinner, right? And please make sure you're muted, co-host. Cheeky. Man had to put a little sheesh in there. Come on. And as we go down to the middle of the prices, right? Again, imagine this is like, for example, the price of a house, right? Imagine this is, for example, 100. And obviously, as we go down, this is like, let's just say 0 equilibrium. And obviously selling, right? When we go lower, that's going to be obviously, actual selling, right? If you're selling the house, as people sell the house, right? It's going to go more and more. And this is how the orders are stacked up in the market. The orders are stacked up here, guys. The big money, they don't diddle in the middle. Because think about it, right? If you're selling a house, family, would you rather sell a house for, £20 here? Let me change the color of this. Would you rather sell the house for, £20 in the middle? Or would you rather get a premium price and sell that house for, £100? Or, okay, as a house, right? Would you rather sell it for 100K or 500K? Tell me in the chat box. Would you rather sell a house for 100K or 500K? I don't even know where the chat box is gone. No, there we go. 500K, of course, right? No, you can't record this. This actually will be up on my YouTube family. So if you're not subscribed to my YouTube, youtube.com/master of coin, we've got a lot of value on there. So make sure you're subscribed to that. I will put it in the chat box for you guys to go to. But what I want you to understand, right, is the banks, guys, they're going to get the most premium levels of price they can in the market, right? They're going to get the most premium levels of price they can in the market. So what I want you to understand is, there goes the YouTube there if you want to subscribe, but they're going to get the most premium levels of price. And the big orders come from the top of the market or the bottom of the market. So where supply and demand operates, of course, you're going to get, supply and demand in middle of the ranges, but we'll speak about that in a second. And how you're going to know where supply and demand is introduced into the market is simply 4 ways. And there are only 4 ways that supply and demand can get added to the market. There are only 4 ways that supply and demand can get added to the market. The first way supply and demand can get added to the market is price drops. It goes sideways. Because what we do as Wykoff traders, family, as Wycoffian traders, is we understand and we analyze consolidation patterns. So when you see Wykoff, right, a lot of traders, they see price going lower. And what can happen now is only 2 things. Demand can be introduced. And how do you know if demands are being introduced? By market behavior. Market behavior of demand is defined by the manipulation of the low, followed by a break of structure to the upside. So that's your accumulation, right? Accumulation is a manipulation of the low, followed by a break of structure to the upside. You have to see manipulations of the low. You have to see, this drawing's not the best, let me make it better, right? So price will come lower, it will form lows, it will form liquidity, it will manipulate the lows, it will take the lows and then continue to break structure and then continue higher. And that's your accumulation. That's demand coming in the market. The second way demand can come in the market is what we call a reaccumulation of price. A reaccumulation of price. That, and I'll show you some of the schematics in a minute to give you actual more detailed levels, but that's when price goes higher, it goes sideways, it consolidates, make it better, it goes higher, it can go sideways, it manipulates the lows and then breaks structure to the upside, and this is a reaccumulation of price. Again, accumulation is a manipulation of the lows followed by a break of structure to the upside. That's your accumulation. That's how demand gets added. Now, supply, sellers can come in the market in only 2 ways. And the reason it happens in these ways is because banks have to actually hide their orders. If a bank wants to trade, family, because they're trading with so much capital, they can't come in and just drop 1 million lots. Joe, go back to Bitcoin March last year, right? That is panic selling. That's institutional panic selling. When you see the price go from like 10K to 4K in a day, right? That's institutional panic selling. So what they have to hide their orders. So how they hide it is in these forms of consolidation patterns, which retail, they shy away from consolidation. But as Wycoffian and smart money traders, is we understand market behavior, and through understanding market behavior and where these patterns occur, well, they're not patterns, market behavior, where these things occur, you're going to be able to anticipate if it's going to go higher or if it's going to go lower, because that's obviously how you make money in trading, right? Getting the direction right. So the next way so this is demand, accumulation or reaccumulation, and that's the only way price can get added to the market. And I'll show you the price cycles in a minute. And then supply gets added into the market where price drops lower, it goes sideways, it manipulates highs, it breaks structure to the downside, and that's your redistribution of price. Right? And typically your redistributions will occur in the middle of the range. Same thing with your reaccumulations. Let me make this full screen. And then you've got obviously your how do I say? Where's the pen gone? There we go. You've got obviously your distribution where price goes higher, it goes sideways, it manipulates highs, breaks structure to the downside, and then continues lower. This will typically happen at the top of your ranges. So that's your distribution. Now, if you want to look at the actual textbook schematics for this, I'll show you. And this is where you're going to occur in a trend as well. I'll show you that in a sec. But if I actually pull up some of our schematics for a second, I don't know if you guys, can you guys see the schematics? No? Okay, can you see schematics now? See schematics now, yeah? Okay, so guys, this is your accumulation, right? Now, again, these schematics are not chart patterns, it's market behavior. I want you to understand that schematics are phases and events. Now, as we get into the chart, and as I'll show you guys actual schematics, I'm gonna walk you through what the actual phases and events mean. But yeah, so this is your accumulation, right? Now, again, we're gonna get into the phases and events when I actually show you a trade that we took. So that's your accumulation. This is your price cycle. So again, shout out to Trade House, shout out to IM Academy. Where you obviously get your reaccumulations, right? Is you're going to get your reaccumulations typically. Where's the annotation tool? Right? You're going to get your reaccumulations in the middle of the trend. You see where the little Trade House logo is? And after you get that sign of strength, that's when you're going to get your reaccumulations. And this is just what a trend is, guys. A trend is your lower low and then your higher high. This is literally what a trending market is. It's accumulation and distribution. That's your market cycle. That's your second type of accumulation schematic where you don't get that final manipulation lows. You've got your distribution schematic. I don't know why this looks so bad. You've got your distribution schematic, which is your quote unquote head and shoulders pattern. Or you've got your second type of distribution where you get that final manipulation to the upside. Now, what I want you to understand is what happens here, guys, is it's taking out as many traders as possible. Right, these manipulations at the high, what's happening? Traders are getting stopped out of the market. Think about it, right? If you enter, you enter your point of interest at your buyer's climax, you get stopped out. Oh, it's going lower. You're in profit. You're excited. Then it comes up and takes you out, and it starts dropping again. Now you're emotional. Now you're thinking, what the hell? What's going on? Now you're entered the market, and guess what? It comes up again, gives you that up thrust after distribution, and claps you out again. Now you're thinking, what the hell just happened? I just got stopped out, and you see it drop, and you just watch it drop because you've got no more money left. But this is why you manage your risk and only risk. Well, I'm not going to tell you how much to risk. You guys can obviously figure that out, but don't risk more than 3% per trade, right? Manage your risk, calculate your lot size every time you take a trade. Now, there's also reaccumulations of price here. Here are your different reaccumulation schematics. And the whole purpose of a reaccumulation is basically it's a distribution that happens. So supply tries to come into the market, but the sellers can't sustain it. So typically, if you're looking at a reaccumulation of price, this is what you're going to see as, and again, these are not chart patterns, family. Don't try to memorize these as chart patterns. This is a study of market behavior. And again, we're going to get into the market behavior in a second. But typically your reaccumulations, because the biggest problem Wykoff and traders face is determining if it's reaccumulating or distributing. So reaccumulating, meaning more buyers coming into the market, and distributing, meaning sellers are coming into the market. And how you can normally how you can normally identify what's happening is, again, by market behavior. Accumulation is a manipulation of the lows followed by a break of structure to the upside. Look at all your schematics, right? All of these reaccumulations are manipulation of the low followed by a break of structure to the upside. You go back to your original accumulation, manipulation of the low, boom, selling climax, stop losses below there. Secondary test in phase B, claps out anyone who was selling at the seller's climax, the SC. Spring comes in and claps out everyone there. So now what's happened is all the retail traders, all the dumb money, all the weak hands, the people that can't have big accounts, that can't handle drawdown, they've been taken out of the market. And the reason this has to occur is because trading is a two-sum game. Right? In order for you to make money, someone else has to lose money. So what happens is the banks, to get filled in their trades, is they need someone else on the other side of their order, right? But who do you think the banks are buying the orders off? So what I'm saying, they have to get the orders from someone, and that someone is the retail, the retail world, right? Like, do you really think trading is that easy where you can? Hey, we just hit 420. Do you really think trading is that easy where you can just come on Google and just type in Forex chart patterns? Like, family, do you really think these chart patterns work? I mean, hey, don't get me wrong, right? I'm sure if you're consistent in your approach, there's probably a few traders who are consistent with this. But if we understand the actual facts, how many traders lose, we understand that 70, 80, 90% of traders fail. And the reason they all fail is because they trade and look at the markets in the same way, and they think about the markets in the same way. So let's get into some examples, right? Let's get into some examples. Does that all make sense so far, family? Right? Let me check the chat box. Does that all make sense so far? Right? Are you with me? Put a 111 if you're with me. Oh, I don't know where the chat box is. That chat box is gone. Chat box has disappeared. So cool. Let's actually look at this in terms of an actual trade we took. Now, the trade model I'm going to show you is through an accumulation, and we're going to get in detail at Wykoff. So if you get lost throughout this, don't worry. Again, we'll get into this a little bit more. So cool. Let me just make this, adjust this. minimize this. Sorry, I'm just making this clear because we're about to get in the charts. And you know, when we get in the charts, we're going to get saucy. So first thing you want to do when you analyze the chart is you need to understand what currency pair you're trading, right? What currency pair you're trading, guys. You need to make sure you're trading the currency in the relative session. So if we do this, if we look on this chart, right, we're going to start off doing a top-down analysis. And what we can see here is for this trade that was actually taken, firstly, we have to identify who's in control, buyers or sellers, right? If we look at obviously here, firstly, we had a downtrend, sellers are in control. Supply is coming into the market, right? And if you actually go to look at these areas, right, this is going to be fractal distribution. The only reason the market moves is from accumulation and distribution. Now, what happened here is price come up and it broke past this level. This is what you call a breaker structure. And when you have a breaker structure in the market, what that means is that the sellers are no longer living here. Sellers are invalid. So if the sellers are not here anymore, who lives here? The buyers, of course. So now we know that obviously now we know yes, again, this recording will be on my YouTube family, youtube.com/master of coin. Again, I'll put the link here. That's my YouTube. Subscribe and the recording will be on there. But yeah, so cool. So obviously we know the buyers are in control. So now we have a pullback and we have a more confirmation that buyers in control. So the area where demand is present is between this low and this high, right? So we mark up, this is our trading range. This is our range. So now what we got to look at now in this range is where are the different areas of supply and demand. Now we can see different areas. And the first area that draws my eye to is this level of demand down here in the market. And the reason this is a level of demand in the market is if we go back and replay it, I'm gonna blow your fucking minds, bro. What is this? The reason this is a level of demand is because this is a fractal accumulation. All right, you don't see it yet. You don't see it yet. But let me share with you the accumulation. Wait. There's your accumulation. And we're going to get into the market phases, a preliminary supply, a seller's climax, all mat reaction, secondary test, but bullish intent, and then you get your secondary test in phase B, that manipulation of the lows, reaccumulates orders, and then goes higher. Now, again, I'm going to show you some real textbook schematics to train your eye, but what I want you to realize is not every schematic is picture perfect, right? It's not picture perfect. You know, you have your redistribution here, right? That's that redistribution of price. What is it? The manipulation of the highs, followed by a breaker structure to the downside. That's your redistro in the middle of the range. What happens? We get another fractal redistribution, more supplies in control. Again, I'm going to proper break down one in a second. Don't worry, like in step by step, and how to actually trade it, how to take entries. And I believe the trade was like a 1 to 70 risk reward, which we'll get into. Meaning what? You risk £1, you make £70. Past profits don't guarantee future results. I'm not a financial advisor. All disclaimers do apply. But cool. What do we have here? If we look at us, who's calling me? Why are you calling me? You should be on the call. Anyway, so this is our level of demand. Now, the trade, that wasn't a trade. So that was our level of demand. So what we do now is we wait for price to come into this zone. So now if we actually take a look back into this zone and we actually start to zoom in, and the reason we zoom in, guys, is I want you to understand the market is fractal. Now, what do I mean by the market being fractal? When you go from the higher time frames down to the lower time frames, it's just like Google Maps. Check this out. All right, I'm gonna teach you how to trade Forex with a map. Watch this. Watch this. Listen, no one does it like the master of coin map. Let me teach you how to trade Forex with a map. And if you can, because guys, it's the law of oneness, right? The laws of the universe. Guys, it's the same thing relates everywhere. Check this out. Imagine the weekly time frame. I'm in Bali right now, all right? Shout out Bali. Why can't I annotate? Okay, for some reason I can't annotate, but imagine this, right? So if I'm in Bali right now, right, just here in Indonesia, and I want to go to Australia, imagine the weekly time frame is me going from here straight to Australia. It's just go from here to there. Now imagine if you go down to the 4-hour time frame, you're zooming in. So if I go down to the 4-hour time frame, I've got to go from Canggu area, I've got to go down to Kuta, I've got to go down to the airport, I'll get on a plane, I've got to go fly to the airport. Now once I fly and land in Australia, what do I have to do? Right? You see, we're zooming in. If I go down to the 1-hour time frame, the 50-minute time frame, I'm zooming into the map a little bit more, right? Again, I'm in Canggu. If you're in Canggu, shout me. Let's meet up. Where's Canggu? Somewhere here, right? So if I'm going on to the 50-minute time frame, I'm seeing all the roads now. I'm seeing it a lot more in detail. I go from Bureau Beach down this road, turn right, boom, go past the hotel, go all the way down here, go all the way down here, get to the airport. Get on the airport, check in, go on the plane, go to the 1-minute time frame. I bet now you're going to see every single red light, blue light, every single shop. Does that make sense? If we go to the chart, Boom, 4 hour, daily, right? Daily's the zoom out. It's the overall swing. What's the direction? Upside. Why is it to the upside? Higher time frames bullish. We've got bullish market structure and we've got a level of demand, right? That's our whole narrative. That's our destination. That's our narrative where we're going. Now we want to zoom in and know the exact roads, because if you're traveling somewhere, look, if I'm trying to go back to, I'm not going back to UK for a long time, but if I want to go to America, right? I can't just say, oh, I'm gonna go to America. I got to know exactly what road to go down. I got to know exactly what street to get into, what airport to check into. Same thing with the market. You got to understand how the time frames correlate. Every move begins from the 1 minute time frame, but it follows the higher time frame strength. It's like the ocean, right? Imagine you have the ocean, right? You have the tide. Is the tide in or is the tide out? Right? If the tide's in, obviously it's going, or it's coming, like, there's less like sand. You can tell I didn't do geography, right? But if there's less sand and more water, that means it's going one way. If there's more water and less sand, it's the other way. It's like bullish and bearish. So what you can do in the market now is you can understand that with the tide, you have the overall tide, but then you can look at the waves, then you can look at the ripples, then you can look at each little water droplet. Same thing in the market. So what we're doing is now we have this demand zone and we can start to see market behavior as we approach this demand zone. Now check this out. What did the first thing I show you guys, right? Check the chat box. Chat box doesn't work. Too many people on the call. So remember what I said, right? The big money lives at the top. Check this out. I'm going to blow some minds. Get ready to have some breakthroughs. Is this really live, mate? Yes, it is. It is live, brother. It is live. So check this out. At the top, we've got the big money in the market, okay? So we've got all the big orders. All the people want to sell at the premium prices, right? Now, check this out. Look at the size of the impulses as we're coming through the top layers. Big impulses. We're seeing supply come in the market in every area. Supply, redistribution, supply, right? Supply. Again, look at what it does up here. It distributes. I'll show you the distribution schematic. It's the same thing over and over again, bro. Like, you can't make this up. Look, it's literally the same thing. Look, buyer's climax, up thrust after distribution. Go back to the chart. Where's the chart? Same thing, right? I'm gonna show you the accumulation schematic because that's the trade I actually took. So I don't want to show you a trade that I didn't take. So yeah. So cool. So now as we start getting down here, look what happens. We start coming into the demand. As we start coming into the demand and the demand gets stronger, notice what happens. The selling impulses get weaker and weaker. Check it out. Check it out. Yeah, I'm teaching you guys how to read the market like, properly. So check this out. Look at the impulses. Big selling impulse. As we come near the demand, look how small the impulses are getting. Let's measure the moves, right? Let's actually measure this in terms of pippage. Where's your pippage, right? Big pips. Shout out Pips of Persia. Big pips, right? 82 pips. Next swing, 37 pips. Okay, maybe a bit more supply comes in the market. 44 pips. Next swing, okay, only 30 pips. Oh, next swing, only 26 pips. Next swing, tries to push lower. Couldn't even push more than 20 pips. Couldn't even go lower. And then you get, boom, evidence of buyers show up, 57 pips. Okay, now, we're gonna get into, I'll show you a 1 minute schematic in a lot more detail. But what I want you to understand about Wykoff, yeah, is look, I'm gonna give you examples that is gonna make it stick in your brain. If you're driving a car, right? If you're driving a car, you can't just stop, right? If you're trying to turn, right? If I'm going, down the road and there's a cut, like a corner, I can't just go boom and like if I want to turn around, I can't just do that. I can't just do that. What do I have to do? I have to turn my wheels around. I have to turn around. Right? What side of the curve are you on? A lot of you are losing trades because you're on the wrong side of the curve. You're on the sell side of the curve compared to the buy side of the curve. Look, sell side, sell side, sell side, sell side, buy side. You get that? Right? It turned around. It turned around. What do we get? A manipulation of the lows. A manipulation of the lows. A manipulation of the lows. Followed by what family? A break of structures to the upside. Why is that important? Because sellers live here. Now, I'm not going to get too much into supply and demand because that's for our academy. But check it out. If you're not in the academy, oh my God, you're playing yourself, innit? You're playing yourself. I'll show you guys about that later. So boom, we have that break of structure to the upside. Now, check this out, right? Let's look at our accumulation when we took the trade based off. So let's actually zoom in, right? 3 minutes. Check this out. Let me replay it to the entry point. And if you, cool. Check this out. Right. So this is the accumulation play. right? It's an accumulation play. Check this out. Let me show you the schematic first so we can train your eye, and then we'll get into the chart. Cool. Accumulation, right? Cool. So obviously, right. So look, okay, what I want you to understand about, okay, it's not, guys, if you want to know more about the academy, message me on Instagram, instagram.com/IK Davis. Make sure it's this Instagram. I'll show you everything with our academy, our live sessions. Guys, we've got over 200 educators going live every single day. 200 educators going live every single day. All right, message me on Instagram. That Instagram only. There's a few fake accounts. Guys, if you don't get on the phone with me and you don't hear my voice, it's not me. Like, understand that. It's not me. If you're in the academy, well, you must know Wykoff. I mean, it doesn't matter if you know Wykoff or not. Wykoff is the only way the market moves. So you can know it or you can't know it. It doesn't matter. The market doesn't care what you know, bro. I'm being savage with you, right? It's tough love. Right? The market doesn't care what you know. The market's going to do what it's going to do. And this is the only way supply and demand in the market moves. This is the fact of the market. How we trade is market facts. We don't look at theory. We look at facts of the market. That's how we trade. So yeah, I hope that wasn't too savage, bro. It's all love, isn't it, family? But yeah, so cool. Where are we at? So the schematic. So watch this. It's not a pattern, bro. Don't try to label up your schematics. Label up the phases. Check this out. Phase A. What's phase A about? Phase A is the stop in action, right? It's the stop in action. It's stopping the prior trend. Now, what do I mean by stopping the prior trend? Let's say you're okay, cool. So your seller's climax, right? If you're on a car, or you're going 100 miles an hour, right? Again, that's why your sellers are in control. You're going 100 miles an hour one way. You stop the car. You do emergency stop. When you're in the car, what do? You stop, but then you have that little jolt. That little jolt is your automatic reaction. What's happening at your seller's climax is you're tapping into that first level of demand and you're getting that automatic reaction. The secondary test is to test a little bit of the demand, but because you're not low enough and you haven't dipped into enough demand, that's why it creates that small higher high sometimes, that little bit of bullish intent, and then comes and claps back down because it's tapped into more supply, which is your preliminary supply here. The whole point of secondary test is to, okay, so phase A is to stop in action. The purpose of phase A is to stop the prior trend. Like I'll show you the example in a sec. Phase B is to confuse people, is to accumulate the orders, because as price is going sideways, it's now consolidating, it's cause and effect. Sorry, pardon me. One sec. It's cause and effect. Everything needs a cause and effect, right? They accumulate the orders. They take price sideways, so people don't understand what way the market's moving. They're saying, is it going up? Is it going down? What the hell's going on now? They're confused of what's going on. That's the point of phase B, to shake you out, to make you enter prematurely so you get stopped out. Again, you see your break of structure. It's not a break of structure because supply is still in control, but we'll get into that later on. You enter here, you get stopped out. Oh, why does it stop me out? My trade's wrong. You start selling the market. Maybe it comes down, creates a new lower low, but that's your spring. The whole point of phase A, guys, is to accumulate orders because opinions are being formed. People are buying, people are selling. So as opinions get formed, again, people are buying and selling. And what happens is these people, they get liquidated. Liquidated just means they get stopped out, right? I'm using fancy words because I'm cool. I'm joking. Right, liquidated just means getting stopped out, right? They're hitting their stop loss. And think about it. When you hit your stop loss, right? If you're buying the market and you hit stop loss, you're selling the order back. If you're selling the market and you hit stop loss, you're buying the order back, right? And you're giving it to the other person. Who are you buying your order back off from? Yeah. So it's going into the other hand. So this phase B, the purpose of phase B is to, again, to allow opinions to form and to confuse people in the market. So as phase B occurs, that's where you get a little manipulation as well. Now, phase C is the real level of manipulation because during phase C, that's when you're getting that final shakeout because some of the weak-handed buyers, they've entered too early, they're impatient, they enter here, stop loss again. You've got your W pattern, right? You've got your double bottom, you've got your market patterns, which don't work. So what you got to understand now is phase C is about those final manipulations and that final shakeout. And the reason it's the final shakeout is because it's dipping into the demand. Remember, buyers live at the bottom, so it's dipping into the demand. What happens next is you get phase D, where the buyers are in control. And as we see phase D, that's the confirmation of the schematic, and that's where you want to go ahead and enter phase D and phase E. The rest, you just got to sit on your hands and wait. So let me show you the market. Can you see it? No worry, I'll show you it. Phase A. Now again, they're not chart patterns. Phase A, right? We're stopping prior trend. We're stopping the prior trend, right? We're stopping the prior trend. So notice that, right? If we look at volume, look at that, big volume as well, right? Big, again, if you're in a car, if you're in a car crash or you're in a car, you're going to stop the market. So you're going to stop your car, right? You're going to have that stop in action, right? So this is your change of character. We're not going to get too much in change of character because change of character that actually determines if the market is going to be accumulation or distribution. So when you can analyze the first change of character, that will tell you what it's going to do, but we'll talk about that for another day. So phase A is stopping the prior trend. Now we move into phase B. Phase B, what's phase B about? Phase B is about consolidating and building the cause. Phase B is consolidating and what we call building the cause. The cause of what? The cause of allowing traders to for opinions to be formed. Look, right? Break a structure, buy the market, get clapped. Right? What's it doing? It's manipulating lows, it's building liquidity. So that's what phase B is about. Phase C. Phase C is those final manipulations, right? That's where you're getting that spring, you're getting that secondary test, you're getting those final shakeouts. So remember what we said, accumulations, what? Manipulation of the lows followed by a break of structures to the upside. What do we get next? Phase C, after phase C, we now move into phase D. So again, oops, I forgot to write this. So phase C is manipulation or shakeout rather. And it's also, again, remember the demand I was telling you about, demand lives at the bottom. So it's tapping into more demand. As we tap into that demand zone, we're seeing obviously the market start to round off as we come deeper into demand, right? It's oversold, quote unquote, right? You don't need divergence, ain't no indicators, price actions we need. Like any indicator, I mean, cool, we can find divergence. Oh, look, divergence. I mean, fuck divergence, bro. Like you don't need divergence. You need to know what the market's telling you what to do. So check it out. Phase D. Phase D is when your buyers are in control. Now, typically, did I tell you like this? Oh, fuck it, I'll give you all the source. So typically, right, phase D, when you see the sign of strength, this is a fractal reaccumulation. Write that down. Phase D, you're going to see fractal reaccumulations. You don't always have to buy on the, like, look, because you got to realize, yeah, demand's, okay, this is a whole call. We'll do another call soon on exactly where supply and demand gets added in the ranges, because and candlesticks and stuff, because that's like, yeah, I don't want to be here too long. So anyway, right, phase D, we've got this fractal reaccumulation in the market, right? This fractal reaccumulation in the market. So where do we enter? I'll show you where we enter. Based upon the breaker structure, what do we have? We have sellers in control. We have those manipulation in the low. Clap. Clap. Guess what? Clap, right? They get stopped out. Look how many people are getting stopped out. Look how much liquidity is getting pulled. Clapped, clapped, clapped. Now, the break structure, the breaker structure confirms the schematic. The breaker structure confirms the schematic. Write that down. Now, guess what? What do? We pull back into our demand zone. And then, oops. There's your entry. Stops can go below the low. Now check it out. Right now, oh Kieran. Now again, if you don't know how spreads work, spreads are less likely to take you out on the buy side. It's all gone to the bid and ask price. Again, I'm not going to go down to that. The academy goes through that again in more detail. So anyway, now we've got our stop loss. Where are our targets? Let's look. The market's always going to go to the point of least resistance. Check this out. Price supply zone. Check this out. Actually, no, we're not going to get into that. Oh, what did I just change? The webcam just went off. My bad. Oh no. Come back. There we go. Hey, I know you missed my face. So check. Okay, we're not going to get into that. So anyway, so what do we have? Right, we've got prior liquidity resting. Right, we've got our targets. Now again, look where we are. We've got a higher time frame, and now it's just about managing your trade accordingly. Right, trade management is a lot more important than trade execution. And as you can see now. And again, this trade was actually held. Now, again, when you take these trades, again, if you don't believe me, I don't really care. All the documentation is on my Instagram. If you want to go to my Instagram, in the trade tab, you'll see all the trades posted there. So now, again, once you've executed the trade, again, time of day, right? This trade, again, look at the currency pair, AUD, NZD, right? Look at this. Again, this says like almost 7 a.m., but I'm in Asia right now. So because I'm in Asia right now, this is the start of the day. Start of the day. All right, look what happens at the start of the day. Let's play the market. Start of the day. Start of the day, bro. Get it, please. Start of the day, market starts to go up. Look at this scalp entry swing trade. Watch it go. I don't want to get too much into targets because the main thing I wanted to get into was accumulation. So now when you're in your trade, guys, right? The most important thing is not execution, is trade management. Because once you're in your trade, you're going to be able to determine if supply and demand is being added or taken away at certain levels. And that's how you'll be able to hold trades for longer and know when to take partials and know when to get out. Now, of course, trades like this, like again, the 163, not the best. I mean, it's pretty good. Don't get me wrong, right? It's pretty good. But like trades like this, I want you to understand that we don't hold the volume for the whole trade. I want you to understand that we take partials as we go, right? Like if anyone tells you they hold the whole volume for these high risk rewards, that they're lying. I'll be honest with you. Like no one holds the whole volume of this, and because ultimately, again, as you're trading, you've got to pay yourself, right? Like we end of the day, we trade to make money, bro. If you're up, like think of it like this, right? Bridgewater, average return. Bridgewater is one of the highest paid, one of the largest hedge funds in the world. Their average return per year, look at that, 12%. So yeah, their average return is that. So even if you're getting like a 1 to 10 or a 1 to 5, like don't compare yourself to us. Like guys, I've been trading since 2018, but it's not about how long I've been trading for. It's about how many hours I've put in and the mentorship I've had. The reason we can get these bigger risk to reward trades and the reason we can execute these trades with so much certainty. There was bare re-entries on this trade as well. What the hell is that? Oh my god. There's a big bat. Oh my god, there's a big bug here. Jesus Christ. The fun of living in Indonesia, right? Look at the size of that beetle, bro. But oh my god, there's a massive beetle that just flew it. If y'all can see this, bro. Oh my god, go away. Go over there. Okay, the beetle's not gonna stop the training, right? This thing is huge, bro. But yeah, so back to this and trade management, right? Back to this trade management. Dom, bro, if you could turn your camera off, that'd be helpful. Yeah. So okay, sorry about that, family. So again, trade management, right? We've got areas of imbalance that has to come and get filled, right? There's thin liquidity here. There's thin liquidity here, right? So these are areas where you can obviously monitor this liquidity, and obviously as the trade plays out, again, trade doesn't. You can see demand doesn't get invalidated. Jesus, this bug is huge, bro. You see the size of this thing. But anyway, the trade doesn't get invalidated, right? The trade doesn't get invalidated. And that's the main thing. Why? Because we're trading with fact-based trading. Guys, this is how you can trade less and make more. Oh my God, everyone's going crazy in the chat. Sorry about that, family. I don't know what the chat box is. But yeah, you can see, obviously we get reaccumulation, and there's no reason to exit the trade whatsoever. Yeah, the bug's gone. But yeah, so we're gonna get into Q&A if you guys want. But I want you to understand it's the facts of the market. Like when you're looking at obviously schematics, yeah, it's market facts. There's no guesswork. There's no like guessing. It's all pure market facts, right? It's all pure market facts. Why did we get out? Because it distributed. Same, you know what I mean? Like so again, I don't want to get into like too much today because I don't want to overwhelm you guys. I want you guys to go and back test this. But if you guys did get value from this so far, and we will have a Q&A, I want you guys to join my Telegram. It's t.me/IK Davis. We'll be posting many trainings in here, many public calls, many breakdowns of trades, entries. Sometimes we'll call signals, not all the time. But yeah, if you guys do want more value, definitely join this Telegram, t.me. I've got a lot of courses. I've got a whole smart money bootcamp that goes through lower time frame entries on my YouTube family, crypto bootcamps, chart checks, more trainings. So if you guys want value, like check it out, man. Plug in. Guys, the quality of your life is determined by the quality of the questions you ask. So don't be afraid to ask questions. Here's the Telegram. Join that family. You get a lot of value. So let's get into some Q&As. How do you join and is there an entry fee? If you want to join, bro, again, message me on my Instagram, instagram.com/IK Davis. Message me. I'll give you more information. We'll hop on a call and take it from there. But guys, if you guys have any Q&As, let me know. Best way to differentiate between, if we don't have Instagram, you can message my WhatsApp, 44796883543. Yeah, you can message my WhatsApp. Yeah. can join my Telegram. I'll put it in the chat box for you. And my Instagram.com/IK Davis. Yeah, there's a lot of fake accounts going around, family. So if it's not that, if you don't hear my voice, if you don't hop on a call with me, it is not me. How to use Bloomberg Terminal. I don't look at that. I don't really look at fundamentals, to be honest. Like, I'll be real with you. The only way I'll look at fundamentals is I'll come on the chart, maybe go to Forex Factory. Like, I mean, you can look at fundamentals, but if I'll be real with you, fundamentals is just an excuse for liquidity. Like, that's the thing. I'll look at here to see maybe where the big moves are going to occur. But to be honest, like, you don't need to look at this, because I'm telling you, right, Wykoff is like, if y'all guys have been following me for a while, yeah, you've seen every NFP, we've literally predicted it, right? We've literally done videos of, look, the market's here, and then literally later it fucking booms. So yeah. Actually, if you guys want to know more about what we do, we're actually having a call in literally 8 minutes. That's going to be breaking down the entire platform as well. So I'll give you guys the link to that. But let's get into some more questions, family. Where's the Q&A box? What were some of the key things you were backtesting to give you the biggest breakthroughs? Honestly, just backtesting what I was taught in the academy, bro. So as I was watching Lex Waves, as I was watching Starboy, as I was watching Zach McDonald, as obviously I was having calls with Pips of Persia, I was just backtesting obviously what they were teaching me. That's it. Like, the point of backtesting is to train your eye. Like, a lot of people, yeah, when they backtest, they come and do this, right? They'll come to the market, they'll go to London Open, right? And they'll just replay the chart and they'll go, oh, okay, let me analyze. Okay, oh, I got this institutional candle. Okay, let me take the sell here. That's not how you backtest, right? How you backtest is you come to areas, you put a line. This is how you backtest, right? You come to an area, right? Any area. So let's say, for example, we come here, right? We find this area here. We put a line on it. We look left and we see what it reacted off. Okay, it reacted off this demand zone. Okay, cool. Now we see we've got the demand zone, right? Now we've got the demand zone. We can go and zoom in on this area and see how price reacts from the area. That's how you backtest, just training your eyes. Why does the chat box always disappear? Which academy? So I Am Master Academy, my bro. Again, if you want more details on I Am Master Academy, you can message, join my Telegram, or message me on Instagram, or WhatsApp me. 447-968-835. If you message me with trading inquiries, you'll get a link to my calendar. We can hop on a call and we'll take it from there. Yeah, so guys, we'll be doing much more Zooms, but I think we're gonna, okay, some more questions. When you're highlighting a supply and demand zone, do you take the candle from the wick? So to me, it's not really about the demand zone, bro. I don't really care about the demand zone. It's more about what happens in the demand zone, to be honest with you. But like, it depends. If it's more like wicks, because yeah, wicks. Yeah, bro, institutional candlesticks. I've taken trades on the 1 second time frame. The way you trade the 4 hour, the way you trade the monthly is the exact same as you trade the 1 second. It's the same thing. If you have a higher time frame demand zone daily, let me stop the recording. So family, for everyone plugging in on the YouTube, thank you so much for plugging in. I hope you guys got value. Drop a comment with everything you liked and learned. Make sure you comment, like, and subscribe, and I'll see you at the top, from the top, because the bottom's way too crowded.